So, to sum up mutual funds, John Bogle, common sense and simplicity are the keys to financial success. I have tried to make that the theme of our entire analysis of mutual funds. I have tried to give you the depth of knowledge, but without oversimplifying, but at the same time keeping things simple. Jason Zweig says, financial scholars have been studying mutual fund performance for at least a half century, and they are virtually unanimous on several points. The average fund does not pick stocks well enough to overcome its costs of researching and trading them. The higher the fund's expenses, the lower its returns. The more frequently a fund trades its stocks, the less it tends to earn. Highly volatile funds which bounce up and down more than average are likely to stay volatile. Funds with high past returns are unlikely to remain winners for long. In the equity portion, I have told you a lot about timing the market. When do you allocate more to equity? What kind of patience you have to have? I also told you that I am somebody who would follow Benjamin Graham's margin of safety approach. I am not going to talk about it once again. Those of you who are interested in how much to allocate to equity, when to allocate, when do I put more money into the stock market, how do I approach stock market investing, please go, I think those stocks are there on Deepak's website. Go to the margin of safety section of the talk on the stock market investment. I think it's called an equity investment model for the common investor, that series of talks. The only thing that I want to tell you is, if you are a systematic investor, you are investing something every month, then the levels of the market do not matter. Just continue with it. Then it is staying the course. That's important. A little bit of wisdom from John Bogle. More than ever in these days of complexity, simplicity underlies the best investment strategies. We have seen this repeatedly. Keep things simple, you are successful in investment. Bogle's simple rules of investment. Invest, you must, he says. You must invest. You have to provide for a rainy day. Time is your friend. If you are patient, especially in growth investments like equity, real estate, you will get the returns over time. Impulse is your enemy. You keep getting impulsive. Okay, I'm impatient. A lot of these people will sell at the wrong time, buy at the wrong time. Basic arithmetic works. You don't need deep knowledge of finance, mathematics, statistics. Keep your expenses under control, both in investment as well as in life. Stick to simplicity. Don't complicate the process. Basic investing is simple. A sensible asset allocation to stocks, bonds, and cash reserves. We saw some part of that today. Never forget the 4 dimensions of mutual fund investing: risk, time, costs, and taxes. Risk, time, costs, and taxes. Risk disappears over time. Costs will always enhance your returns if they are kept under control. Taxes is something that we cannot control because taxes can change. They can change from year to year. They can change with each policy pronouncement of the government. When we are aware of the tax situation that governs us, we have to take prudent steps to get the best outcome under a present set of tax rules. That's all. In investment terms, risk is to reward what breadth is to length in spatial terms. The lesser of the two sides of the plane. Another beautiful concept by John Bogle. We are very used to this saying of higher the risk, higher the return. And when we talk in terms of this, we tend to think of risk and return as a perfect square. John Bogle is saying, no, this is wrong. He is saying you have to draw it something like this. It's not a square, it's a rectangle. The longer the side is the return, the shorter side is risk. And then he says, in investment terms, risk is to reward what breadth is to length in spatial terms. The lesser of the two sides of the plane. That is not to say that risk is unimportant. It is crucial, but I simply do not accept its being counted equally with reward. Faith in the future, an essential element in investing, entails the implicit assumption that return will exceed risk. That's why we invest, because we think that for a given risk, we will be rewarded. If potential return does not exceed potential risk, why invest at all? So when we do sensible things, we slowly realize that that was a risk worth taking. It's another way of saying in our day-to-day life when we go and buy something, if we like the product, if the value the product gave us was more than its cost, even though it may be mental mathematics, we call it, oh, that product is value for money. I eat in that particular restaurant, the food is good, everything is fine, service is okay, prices are not too expensive, I'm getting value for money. Same experience we have had with long-term investing. And I must have told this to you before, but let me tell it to you again. Most investors who are into serious financial planning, we are not even saying perfect planning, but they make an honest attempt to plan their finances. The good things start happening to them, strangely, in the 6th, 7th or 8th year of their plan. It is not instant coffee. I've come with a plan, I've started investing, 6 months later I'm Warren Buffett. No. 1 year, 2 years, 3 years, no, although they start seeing a little bit accumulating here and there. 6th, 7th or 8th year, we find it is not we who are now telling them. They say we have got a little extra money that we want to put. They are coming and they are anxious to build their own plan. Or they say, oh, wish we had started a little earlier. I started at 35, I started working at 24, which I had started within 3-4 years of my working. All this kind of thinking happens when they see something really good happening, not just good happening, something happening better than they expected. That is this. Investing for the long term is central to the achievement of optimal returns by investors. To invest with success, you must be a long-term investor. Your net return is simply the gross return less costs. And costs can be a number of things. Taxable investing is a loser's game. Those who lose the least to taxes and fees stand to win the most when the game is all over. For tax-deferred investing, mutual funds may offer an attractive avenue of investment. See, even if you go for debt funds, after 3 years of holding, it is long-term capital gains tax. The tax rate is 20.6%, but after taking into account cost inflation indexing. Very often this factor reduces the tax greatly. Sometimes you may have a notional long-term capital gains loss in terms of times of high inflation. So if you are willing to remain in a debt investment for 3 years, it's very tax efficient. Now equity after 1 year. So any period or more is tax-free as of today's regime. So even in India, mutual funds give you a tremendous opportunity for simple tax-efficient investing. You want something even better? Equity-linked saving schemes, where you get ATC benefit. It's almost the equity version of the PPF. PPF, you get the ATC exemption when you invest. All interest is tax-free. All withdrawals are tax-free. In the equity-linked saving scheme, you get the ATC benefit after 1 year. Of course, there it is a lock-in period of 3 years, but whatever it is, it's an equity fund. When you withdraw, eventually, all withdrawals are tax-free, which means, just like the PPF, the appreciation, the accumulation over your whole period of investing, if it was 20 years, 30 years, is tax-free. Very difficult to think of a better investment for SIP for a taxpayer. Very, very difficult. So I always tell people, The craziest thing you can do is desperately try to go looking for money in the months of February and March. Never do that. See how much you want for tax saving. Is it the full 1,50,000? Divide that by 12. Start a simple SIP of 12,500 per month. Number one, you get the benefit of the SIP. Number two, you have no tension in February or March. While your friends are trying to gather 1 lakh and 1,50,000. All you have to do is worry about the 12,500 installment of February and the 12,500 installment of March, which will anyhow automatically take place. Beautiful ways of tax efficient investing. So these are some of the very, very simple insights given by John Bogle. Now, how do you invest in mutual funds? This is for my other class mainly. I am not really going into it. There is a KYC to be completed. I've given you some of the things that you require here. This is something that is okay in a class of students, but here you'll have your advisors or you can do it yourself. Essentially, there is a know your client process. What you have to get ready is photographs. Today, more and more go for white background stamp sized photographs. You have to always have a proof of identity and a proof of address. Right now, the PAN is compulsory. The Aadhaar could become compulsory for investments after this. Most probably it is because they're making it compulsory in the banks. Passport is also a very good proof of identity as well as address. You must have a correct bank account. The only insight I can give you is please ensure that your name in the PAN card, passport, Aadhaar card and bank account is absolutely correct. Even today, we get so many cases, each place there's a different name. To correct it can be quite difficult. There should be no mismatch. It will pick up, otherwise your KYC may fail because of that. And by some chance, if it's different, take steps to correct it immediately. There are ways in which you can correct it. Of course, the only other one thing is that for any mutual fund investment, your check has to come these days from your bank account. It can't come from a third-party bank account, except in the rare cases like a minor or gift. Ownership has to be proved, that you are the owner of the bank account has to be proved. And bank account details necessary for mutual fund investment. Yes, there is a difference between resident investments and NRI investments. Persons of Indian origin who hold a OCI card can also invest. These are more of processes. In the case of NRIs, of course, the investment must come from either a non-resident ordinary account, NRO account, or a non-resident external account, NRE account. Proofs are slightly different for NRIs and PIOs. A visa and passport is compulsory for NRIs. OCI card is compulsory for PIOs. So these are only procedures. Let me not spend time on procedures. Yes. How do you invest in mutual funds? First is complete your formalities. Second, be sure of where your mutual fund fits into your overall financial and investment plan. All our investment should be with a purpose. It cannot be purposeless. It has to be based on objectives. And to make it very simple, to give you a sort of a structure that you cannot forget, just think of all your investments, whether they are mutual funds or otherwise, as falling into one of three categories. The first category is an emergency fund. The second is a retirement fund. A third is a general investment fund. That's all. Three categories. Emergency fund does not need any explanation. A fund to meet emergencies. When in doubt, 1 year's normal living expenses. round it off to the next higher, 1 lakh. If somebody's normal living expenses are 40,000 rupees per month, into 12 is 4.8, round it off to 5 lakhs. Where do I put it? One of the best strategies, have a very safe, very short-term fund, liquid fund, ultra-short bond fund, short-term floating rate fund. Register a capital appreciation transfer monthly basis to an equity fund. So, if you have a 5 lakh fund, after 1 month, the 5 lakh has grown to 5.04, 5 lakh 4,000. What the fund will do is, when you register the capital appreciation transfer, 4,000 is the appreciation. 4,000 is shifted from there to the equity fund. Choose a diversified equity fund or an index fund. So 5.04 goes back to 5. Second month, if it is 5 lakh 3,500, 3,500 goes. Your emergency fund corpus of 5 lakhs remains 5 lakhs. When you are prepared for an emergency, emergencies rarely occur. So your emergency fund can sometimes remain lying there untouched for years. You have the solace that the income from that fund went as an SIP to the equity funds. And your emergency fund is not your debt fund. It's always A plus B, this as well as the equity fund. Over a period of time, that can amount to quite a bit. So you can use it very simply. Retirement fund. What's the purpose of a retirement fund? The purpose of my retirement fund is to provide for me and my spouse from the day I stop being economically productive until the end of life of the survivor among us. That's the definition of the retirement fund. If you have got a long time to go for retirement, 10, 15 years or more, especially young people starting 30, 35 years, you can go 100% into equity, and in the Indian context, first exhaust your ELSS. Nothing is better than the ELSS. As a SIP, fantastic. General investment fund. There are so many of our needs. They are not our normal expenses. But we will incur some of these expenses as we go along. We may need to purchase a vehicle. We may need to fund a family vacation from time to time. We may need to provide some money for some relation or family member who is not well to do. Children's education, down payment on a house after some time, or you have got a 20-25-year-old apartment or house, you need to renovate it. The cost may be much more than the original cost of the apartment at that time. So you have to provide for all these things. Marriages and other social and religious functions. All these things, general investment fund. When you have a doubt about where to invest, choose something which has got an element of debt as well as equity. 50% debt, 50% equity, rebalanced is fine. Or some kind of a balanced fund, or some structure where you have got both. Once you set up a general investment fund, try not to make the first withdrawal for about 5 years. So give it time to incubate and grow. After that, you can, as and when you need, you can take it out. So instead of thinking in terms of the names, brand names of funds, try to think in terms of these simple categories, objective based. Today I'm happy when many times our clients will ring up. They will not be telling you which fund to either invest in or withdraw from. They'll say, I need to buy a car. My new car is going to cost me 8 lakh rupees. I'm expecting 3 lakh rupees from the sale of my old car. I've got this 5 lakhs that I need. Will you tell me from where to withdraw? They are saying, do I have enough in my general investment fund? From where do I withdraw here? That's all. So if you can think in these terms, is the money for emergency funding? Is it for retirement? Is it for general investment? You make your life very simple. And you fashion your investment products, and for this kind of fashioning, mutual funds, whether in India or abroad, provide a beautiful avenue of investment. Very simple avenue of investments. So like I said, for an emergency fund, any of these, liquid, monthly or quarterly, capital appreciation transfers to equity. Retirement fund, You can choose balanced funds, total equity funds for anything. If it's long term, above 10 years, even straight equity funds, no problem at all. And at least 10% of your take home income. Try to reserve for retirement long time. Even when you need to withdraw, you can withdraw directly from the funds that you have built up by registering what is called a systematic withdrawal plan. Very tax efficient. In fact, as of today, from equity funds, it is tax free. So in retirement, you are not paying tax. Laws may change, that's another thing. And when you withdraw a small amount, many times the principal will grow over a period of time because your withdrawal ratio may many times be lower than the growth ratio of the fund. In India, the standard practice, what I tell people is, try not to withdraw more than 5%. For example, if your retirement corpus has reached 1 crore, withdraw 5% of that 1 crore, that is 5 lakhs. Say 4 quarterly withdrawals of 1.25 lakhs each. That gives you an income of about 40,000 per month, tax-free on the average. And over a period of time, you will find short-term there may be fluctuations, but that 1 crore is not coming down. 5 years later, it may be 1 crore 30, 1 crore 40 lakhs. At that time, readjust 5% to that level. So you can withdraw more. As inflation goes, you are giving yourself the scope to withdraw greater amounts. That's a very, very intelligent way of using it. And for a general investment fund, any good asset allocation strategies, balanced funds, or you have got enough to put in a general investment fund, you yourself have 2 SIPs running, one equity fund, one debt fund. Once in a way, rebalance it. You have to only do it in the same fund house so that you can rebalance very easily. I told you, first withdrawals you can reserve for maybe 5 years after you have made your investment. 15% is good to target, 15% of my take-home income. What we always say is, putting something like about 10% of net income for retirement, 15% for general investment funding, after you have built up your emergency fund. You hit what we call the minimum savings ratio of 25%. In India, if you are not saving 25% of your net income means income after tax and after deductions. For example, for an employee, there will be various deductions. If you are not saving 25%, if I am earning 40,000 a month, I am not saving 10,000 a month, you are failing the savings test. What is, getting a rank? Getting a rank is 50%, saving 50%. I am earning 40, I am saving 20. Not many people can do that, let me tell you. Most people would be 30, 35%, which is good, which is very good. If you are a serious saver, it is very good. You are earning 60, you are saving 20 a month, excellent. That is good. This is barely satisfactory. So here is where we start. And when you are in a position to maximize this, have the same ratio, 2:5 ratio. 2 goes into retirement, 3 goes into general investment funding. It's a simple ratio. So, very quick conclusion to mutual funds. There are 6 areas of mutual fund investment where I see value. I'll very quickly go through them. The first is short-term parking of funds. I just need to keep money there, or I need to set up an emergency fund. Liquid funds, short-term floating rate funds, perhaps short-term funds. Second area, intermediate term, 1 to 3 years, even maybe 1 to 5 years. You can go for short-term funds. Be a little careful of this category of fixed maturity plans. From leading mutual funds, they are okay because they will take the trouble to see that the credit rating is good. But sometimes they can make mistakes and they may not get their money back from certain kinds of corporate debentures and others. So when in doubt, go for this category. Much, much safer. Retirement and tax saving investments. Fantastic. This is the one area where mutual funds have really contributed. By helping people save tax here and by giving simple SIP opportunities for even humble people like, say, rickshaw drivers. Our office must be having half a dozen rickshaw drivers who have got SIPs long term. They have built up tremendous wealth. 500 rupees per month. There are mutual funds that allow you an SIP at 500 rupees per month, 1000 rupees per month. Very, very simple. Small amounts that can be persevered with, and slowly as the income grows, don't jump from 1000 to 10,000. Jump from 1000 to 2000 or 1000 to 1500. Keep doing this at intervals of 2 or 3 years. Anybody can build wealth. So this is one of the strong points of mutual funds. It gives poor people, lower middle class, the opportunity to build wealth without really struggling with things happening in the background. So SIPs I see as even for retirement or simple building of wealth. For small investors, diversified index fund, diversified equity funds, balanced funds, asset allocation funds, SIPs, STPs, use these techniques. Excellent for small investors. Remember John Bogle, if you want to be very successful at systematic investing, you have to stay the course. In fact, if you cannot do it for 5 years, don't attempt it. But you want the best benefits from an SIP in an equity fund in India, it should be 10 years. Fearless investing. I told you about what I call the zero risk STP. There is no zero risk investment, of course, but a simple thing like this, if you put 100,000 into a liquid fund and 1% of this 100,000, 1,000 rupees per month into an equity fund. Even in the global financial crisis, nobody lost their capital. Suddenly, the fear of investing is removed from you. If I don't lose my capital, there is no problem. When you talk about normal people, we have got two fears. One is a risk to capital, the other is a risk to return. Risk to return is, okay, 1 year has passed, very bad market. In this zero risk STP, I got a return of only 4%. If I had put it in the bank, I would have got 7%. That is a risk to return. Risk to capital is, I put a lakh of rupees, that lakh of rupees has come down to 95,000 rupees. People do not really have a risk to return if things are explained to them properly, that you don't look at return in 6 months or 1 year, you are looking at return in 5 years. A risk to capital, you look at it all the time, many times a day if you want to. Because there is no harm in guarding your capital. Safety is very important. Therefore, if you can convince people like this, this is a beautiful way of removing the fear of equity investment from the minds of people. A lot of people would like to invest in the stock market, they are scared. So every good advisor will probably focus on things like this and make use of these simple techniques. Frank Netti says, remember what is more important than your income, it's your principle. The tree is your principle, the income is your fruit. So I am always on the side of anyone who wants to safeguard. First, do not lose. That's very important. John Bogle, the key to fund selection is to focus not on future return which the investor cannot control, but on risk, cost and time, all of which the investor can control. Let's remain with what we can control. Focus on that. You will be successful. And this is also a beautiful way of depicting it. There are things that matter and there are things that you can control. Even though there are many things that matter, we do not have control over all those things. So we should focus on where these two circles intersect. The things that matter, things we can control. And as John Bogle says, you can control risk, you can control cost, you can control time. Prussian General Karl von Clausewitz once said, the greatest enemy of a good plan is the dream of a perfect plan. I told you right at probably at the beginning of today's session, don't go for perfection. reasonably good plan, reasonably sound plan, then stick with it. Okay, he says the greatest enemy of a good plan is the dream of a perfect plan. Of course, asset allocation funds and real estate funds. Asset allocation funds, there are a few. Some of them are not structured very satisfactorily. Real estate funds have not come to India. These also will have a place. So these are the 6 areas where I see value for investors. Short-term parking, there is a facility. Slightly intermediate, 1 to 3 years, 1 to 5 years, mutual funds will give you that. Tax saving, ELSS, yes, mutual funds give you that also. Facilities for even small people to invest correctly. High net worth individuals also can do it, small people also can do it by the simple, humble SIP. The next area is mutual funds have got plans like STPs, which can actually remove the fear of investing from people. And finally, a few of these products may be a little futuristic, but they may have a place in your investment plans when they actually come about. Professor Paul Samuelson has written the best textbook ever on economics. He died. He was a Nobel Prize winner in economics some years back. And his textbook is now being edited and carried forward by his disciple, William Nordhaus, still a classic textbook on economics. He says this about John Bogle. He says, Buffett cannot teach you or me how to become a Warren Buffett. Bogle's reasoned precepts can enable a few million of us savers to become in 20 years the envy of our suburban neighbors, while at the same time we have slept well in these eventful times. So Bogle can come out with it. That's why that low-cost index fund and the way Vanguard is structured, even today, many times investors who are abroad, where do I go? I said, first go to Vanguard. Okay, probably all your needs will be taken care of. I have that kind of respect for that mutual fund. All Bogle's principles are followed there. It is the fund that he started. So those of you who like to read, here are a few books. I've read each and every one of them. Many times I've read some of these books more than once. Bogle on mutual funds was 1993. John Bogle on investing, a classic book of 2000. He didn't update this, unfortunately. Character Accounts, his story of how he built the Vanguard Group, the kind of battles he had over 4 decades. Battle for the Soul of Capitalism, a very good book on ethics. The Little Book of Common Sense Investing. This is hardly 130, 140 pages. A beautiful condensed version of Common Sense on Mutual Funds, which is the classic. Then Enough, True Measures of Money, Business and Life. He wrote this in the aftermath of the global financial crisis. This is the classic book. If you want to read one book by John Bogle, Common Sense on Mutual Funds should be the book you want to read. This is an absolute investment classic. There are 3 investment classics, since probably this is the last in this series of talks for Simplest. The 3 investment classics. One is The Intelligent Investor. By Benjamin Graham. Second, A Random Walk Down Wall Street, Burton Malkiel. And third is, okay, I won't write it here because it's there, Common Sense on Mutual Funds. These 3 books, if you read, you'll know more than 99.9999% of financial advisors, not normal people. You'll know more than them. These are the 3 great books on investing. Of course, there are further things. After the global financial crisis, he wrote a few more books. Clash of Cultures, very elegant writer. So it's good to read. Thank you very much.